I'm Charlotte McLeod with investingnews.com, and here today with me is Chris Temple, founder, editor, and publisher of The National Investor. Thank you so much for joining me. Great to have you here.
Well, Charlotte, it's great to be back with you, and belated Merry Christmas, early Happy New Year, and we'll see if we can give people a handle on the year ahead.
Yeah, really good to be talking with you, and I think it's a perfect time to be checking in because we're just almost at the beginning of the new year. It's also a good time since it's so exciting for gold right now, and we're going to get into everything that's going on there. But before we do, I thought we could set the stage a little bit by talking about what's going on with the Fed and with inflation. I think the last time we talked back in May, we talked about the consistency in Powell's messaging. And now it seems like he's coming away from that higher for longer narrative. So let's begin there. Maybe tell me what you see coming from the Fed in 2024 and the implications for inflation.
Well, Charlotte, I think that the markets have overplayed what seems to be the first part of a so-called Fed pivot. To me, Powell didn't, in this last FOMC meeting, he didn't back away from the idea of higher for longer. I mean, they are not going to cut interest rates for a while, maybe the middle of next year. Some people say earlier in the year. That remains to be seen. What was stark about his changed messaging, however, was that it was less than a month before the FOMC meeting when he was reiterating in a speech that the economy was likely going to have to undergo a period of well below trend growth and a bump up in inflation and a drop in employment, a reduction in wage gains that have happened for the last couple of years, in order for him to be able to declare victory against the inflation, which he was, of course, the biggest proximate cause of in the first place, for printing all the money that he did. And so what was abrupt was when he backed away from almost all of that. And here we have well above trend growth still in the third quarter, the last official numbers we have. And yet he wanted to point out that the economy is finally decelerating a little bit in Q4. The employment statistics have stayed fairly strong. Wage gains are still 4% plus year over year. And so a lot of people were wondering, what did he see or what does he know that he's not telling us? Now, of course, that came out on that Wednesday afternoon. Friday morning, John Williams, the New York Fed president, came out and played bad cop and said, okay, well, hold the phone, folks. It's not going to be that easy. We're not going to reduce rates that quickly. No one's really talking about that. But that renewed genie, I think you can say, was already out of the bottle. And so everybody went buying everything. They bought the Magnificent Seven again. They bought gold again. They even helped push oil up, which has been beaten up lately. All on this idea that any minute now the Fed's going to start cutting rates back to zero and we're all going to be in that happy ZERP land again, which I don't think we're going to see again in our lifetimes. That's a different story. So I think as we start the year, everything has gotten too far ahead of what actually is going to come out of the Fed. So I think that when you've seen this big rally in treasuries pushing long-term yields back below 4%, won't be long, we'll see him back above 4%. I think the stock market, though I'm ambivalent to, believe it or not, slightly bullish on the broad stock market for much of next year. I think that temporarily it's out over its skis. Even the gold price, which has benefited from this drop in yields so suddenly and the U.S. dollar index breaking its uptrend, I think that has a little bit of risk involved in it, but not as much as the other things.
Okay, I'm interested to hear a little bit more about what you see for the broader market. You mentioned you're a little bit ambivalent on the stock market. So can you say a little bit more about what you see there?
You know, as far as the bond market is concerned, I wrote a thing recently and I sent you a copy of it that if you want to understand the markets in 2024, you only need to understand three words: supply, supply, and supply. And that word is going to operate different ways for different things. When it comes to the burgeoning volume of U.S. Treasury debt and other debt around the world that needs to be refinanced, rolled over, added to whatever, because we're adding to the U.S. federal debt at $2+ trillion a year again. It's going to be at considerably higher rates. This year, for the first time, interest cost on a U.S. national debt now exceeds annualized $1 trillion. We're going to be pushing 1.3 or 1.4 trillion by the end of 2024. If interest rates stay where they are right now, that's where we're going to be at the end of 2024. So that you just added another 400 billion. There's going to be increasing crowding out of private sector availability for credit, because you've got everybody, to one extent or another, needing to borrow more money and or print cheap currency. I mean, look at China. China's having to deal with deflation right now. So they're printing money with reckless abandon. They've got the highest debt to GDP ratio on the planet. And so they're going to be looking to create and or borrow more money. And it just doesn't lend itself when you've got such a incredible, almost exponentially increasing supply of sovereign paper that needs to be covered. That doesn't bode well for the rest of the economy. So together with that, I think that a lot of issues are now baked into the cake that are going to keep inflation chronically higher for quite a while than what we've all become accustomed to until the last couple of years. I don't think, barring a massive depression, that we see overall inflation go back to 2%. Now, if you want to buy a car prices are going to drop. If you want to buy a new set of clothes, those prices are going to drop. Electronics, they're going to drop. Food, shelter, fuel, utilities, healthcare, housing, all the rest of this stuff is going to continue to go up at rates well in excess of that 2% Fed target. So I think that we're going to bog down in this coming year into this great stagflation that I've been talking about for a while now. The inflation part of it is going to stay intractable, or we're going to continue to have 3 to 5% inflation. It's going to go up and down. And the headline number, of course, has got a lot of help recently from what I think is going to be a short-lived drop in the crude oil price. So I think it's going to be kind of a blah year. And it's going to, in a good sense, Charlotte, I think it's going to force investors to behave like investors again. We saw the beginnings of this in 2022 when the broad markets dropped a fair bit. Energy started doing well, uranium, lithium, some other themes were doing well. 2023 reversed all that. The Magnificent Seven and the big cap tech stocks went nutso again, and a lot of value stocks fell by the wayside. 2024, the pendulum swings back in the other direction. So I think the net result is, especially if you're in the right sectors, let alone the right stocks, you can still do well in the stock market in 2024, even though I think that recession is going to be a word uttered a lot more as the year goes on.
Really interesting. And we're going to go into some of those sectors that we might see doing well in the headlines in 2024. One more follow-up just on the Fed before we go there. So in this scenario, does the Fed abandon that 2% inflation target? Do they eventually come out and say, okay, that's not going to happen?
They are loath to do that. Jerome Powell would rather have each tooth pulled out of his head one by one than it overtly admit to that. But I still believe that there are so many things. Globalization for 40 years brought down overall wage levels globally. That's done. You look at commodity pricing. You've got resource nationalism that has emerged. So you're going to see constraints on supplies of all manner of metals and commodities the world over. Companies, or countries rather, that have disproportionate wealth in commodities want a greater share of it. You know, in this country, Joe Biden, our president, has been very stingy about mining operations in the U.S. being permitted and whatnot. Yet it's fine to get cobalt from the Congo, and it's fine to get nickel from Indonesia. He's even getting pushback from his own party on that now. But beyond that pushback, we're seeing, even in the Democratic Republic of the Congo and elsewhere, people getting tired of the, quote, imperialists coming in, this foreign capital, taking their resources, leaving crumbs behind. And so there's a lot of reasons why the world over we're going to see a substantially higher price threshold as time goes on. If you want a pound of copper, if you want a pound of nickel, if you want a pound of uranium, if you want pretty much anything. And nobody, for the most part, on this whole inflation, deflation debate that's reemerging, nobody wants to admit or acknowledge even that this is a dynamic going forward that we haven't had for decades, that there's going to be a chronically higher threshold of pricing for these things. So, that is something that the Fed really can't do much about. It can decide to accommodate it by not raising interest rates, or it can decide to try and fight it and throw the whole world into a depression. So the right answer, which is a story and a conversation for another day, is that policymakers need to be part of the solution and not part of the problem. There needs to be a Marshall Plan-like seriousness given in our country, in your country, in Canada, and elsewhere. And you get glimmers of it here and there, okay? But still, there needs to be a very serious game plan put together for where is our oil, natural gas, uranium, nickel, copper, lithium, all of these things coming from 10, 20, 50 years from now. Because policy has been dictated, especially on the energy transition subject, by people with starry-eyed notions who have done virtually nothing, engineering-wise, economically, and otherwise, to make sure these things actually can happen.
Very true. I think that's a much bigger conversation for a different day.
Yeah.
So for now,
I'm sorry, Charles. So the Fed will dance around reasons why it's going to not raise rates, even if inflation picks back up, and they'll blame it on something else. It'll be like in the movie The Blues Brothers, John Belushi's got Carrie Fisher pointing machine gun at him. He's got every reason why he stood her up at the altar. The Fed will give us every reason under the sun as to why they're going to have to stop raising rates, even as inflation picks back up. And that'll be really, I think, when the whole secular story for commodities will really start to get a broadening constituency that it still doesn't have.
yeah. And I think this ties into what's going on with gold. So let's look over to gold. So as we talked about at the beginning, exciting time for gold, but you're mentioning the market, as many have, has maybe gotten a little bit ahead of itself. So if we look back to that last conversation we had, you gave us 3 factors that we really need to see for a real gold price rise. So I wanted to check in and have you review those factors and let us know where we're at with them right now.
Well, the first factor is that we need to have a Fed that is in an expansionary mode, monetary policy-wise. It is not yet at that place. It's taken a step, arguably, in that direction. If Powell and the rest of them, with their winks and nods, really have raised the short-term interest rates for the last time, keep in mind that at least on the surface, they're still reducing their balance sheet by a fair bit. But it's been pointed out that even, in and out the back door through their bank lending facility and their other open market operations, that they're still having to paper over a lot of trouble in the banking system. So number one is that once it's much clearer to the markets that the Fed has ended any further monetary policy tightening, let alone flips in the other direction, that's the first ingredient. The second ingredient is that you're going to need to see a situation where, despite the coming, and it will come probably in 2024, the coming Fed capitulation, where whatever the reasoning, it just cannot tighten and may have to start to ease again somewhat. That can't be seen as helping the broad economy, because look at what happened just recently. You had a situation where everybody scrambled, tripped over one another when Powell gave his surprisingly dovish commentary. Whether you believe it or not doesn't matter. People did. Okay. And they're buying. What are they buying? Did they buy just gold? No, gold responded positively to the idea that the Fed's done hiking, as it should have. But what responded a whole lot more was the U.S. dollar going down, Treasury bonds on a blistering rally higher. 20% gains in Treasury bond prices in a couple of weeks. Okay. You had stocks flying higher. We've got a new high, all-time high for the Dow, for the NASDAQ 100. Maybe by the time this is posted, even for the Standard & Poor's 500. So when the Fed reverses course and is easing, but the economic and fundamental statistics are deteriorating, and people are realizing, oh, maybe we are going to go into a recession no matter what the Fed does. And all of a sudden, what sound like the easy trades of buying more of the Magnificent Seven, buying more high-tech growth and what, that's all of a sudden not looking good. And, I think that the earnings are going to be a lot less going forward than people realize. You look at the news out recently from everybody from Walmart to Target to FedEx, consumers are already rolling over and spending less. If you adjust it for inflation, consumer spending dropped 4% from last Christmas. That's when gold is also going to get more attention, because monetary easing that helps all sectors, gold does okay, but it's more of a wallflower. But when things are deteriorating for the economy and earnings, and the Fed is still printing money, by process of elimination, it's going to benefit gold even more. And that's what we had, in the wake of the financial crisis in 2008. So I think I actually morphed reasons 2 and 3 into one. So I was talking about the markets and the economy both. But as you see the economy deteriorate and the growth stocks start to do worse, yet you've got the monetary tightening, or the monetary easing rather, that's when gold really takes off. And we're getting glimmers of that, but it's not, I'm saying we're at a caution light about to turn green rather than back to red.
Okay. And, thanks for going through that. I think the other thing that you highlighted before we turned the cameras on that I thought was worth mentioning is, maybe we're not quite there on gold, but the downside you had mentioned is limited at this moment.
I think it is, especially for the gold price. I mean, gold stocks too have been so beaten up. I've seen in recent days a lot of gold stocks have started early to recover from their long beating, from the tax selling and so forth. Good names and some that I think are just average. So I think that if you're in the best names, I would not try at this point in time to try and time the gold price. Maybe early in the year, we get a couple of hotter inflation numbers. The market gives back some of what it's done recently, and gold drops to 1900. So what? That won't mean much ultimately in the grand scheme of things. And I think even if that happens, you're still going to be doing well for yourself right now to be buying some good companies when the prices are, everybody that follows gold knows this, that there's never been such a disconnect between the equity valuations and the price of gold. And it's not just gold where that's the case, but it's especially gold where that's been the case. And that'll change as time goes on. But again, I think all of these factors need to come together, and the generalist investors that are out there will ultimately wake up to the fact of the supply theme that as I've articulated it, and others, and realize that going forward, gold is still the uncurrency. It's not a fiat currency. And I think, we're months, not years away from the next major secular upleg. It took us a long time to get to $1,000, which gold touched in 2007, dropped to under 700 briefly in the wake of the financial crisis in 2008. Then it tripled to almost 2,000, in just a few years. And we've been bouncing up and down since then, give or take a little bit. Nominal new highs recently, but inflation adjusted really not. And so I think that, what I'm looking for in the next year or two, with the great stagflation becoming a more entrenched theme, with the massive amounts of debt that needs to be issued and refinanced, with the inevitability that the Fed and everybody else just keeps printing and printing and printing more. They put on a brave face trying to, normalize or tighten for as long as they can get away with it, but that's about done. The next major leg, I don't like putting price targets on things. I like to look at conditions, but I don't think when gold does finally break out, we only go up $100 or $200.
Okay, I think that gives a really good idea where you see gold being right now and a ways into the future. So that's great. I also, of course, want to talk about uranium with you. And the market is looking really interesting. I feel like in 2023, the positive catalysts have just kept building and building. We've seen the price up substantially. And Now, looking forward to 2024, I'm curious what you think investors should be paying the most attention to because everything really seems to be lining up very well.
I'll tell you what's interesting about this. And if you go back a couple of years, Charlotte, as you know, the price for uranium bottomed at about $17 or $18 a pound. That was a spot price. We're now above $90 a pound. In the next year or two, we're going to be at $200 a pound or perhaps higher than that. And really, if I was, a year ago and less, you and I have talked, I said that the single most bullish setup of any commodity anywhere was uranium. And I will tell you the same thing as we're going into 2024. It is still the single most bullish setup for any commodity anywhere, even at $90 that we're starting from, because we have not yet begun to make up the shortfall for what the rapidly growing need is from utilities and other end users. We're starting to see a little bit of panic set in among some of the utilities that played this game of chicken with uranium companies for so long. And all of a sudden they're waking up and saying, holy cow, we don't have that much uranium left and we're going to have to pay up for it. You're seeing a lot of companies that are reemerging in the marketplace to be sellers. The uranium energy corporations and the energy fuels of the world here in the U.S. And they're gonna be printing money for the next couple of years as they're the first ones in line to start making up for this shortfall. I think that the risks and the reason, Charlotte, I say that it's still the best supply and demand setup, among other reasons, it's the least susceptible to an economic shock. The world is still using roughly the same amount of electricity in the electrical grids, whether we're in a recession or not. And so that means that the uranium power plant, nuclear power plants, they still need uranium. And to them, it's not, if uranium doubles from here, which I would take that to the bank in my view, or better. If uranium doubles from here, you have not blown out the finances of a nuclear power plant, because when you add all of the costs together, the cost of the uranium itself is relatively slight. This is not like the price of coal doubling or the price of natural gas doubling. So there is still, because it has now become completely a seller's market for those people who have got uranium in production right now or that can be taken out of mothballs quickly right now, which some of them are starting to do. It's totally a seller's market, and they're going to be in a driver's seat for a while. Not to mention when you go down the road, another maybe 5 years, give or take a little bit, and you've got the first 2 or 3 companies with the best small modular reactor technologies come out, and they need uranium. One of the things that my friend, and I know Scott Melby of UEC, has pointed out, that when you look at all of the long-term charts that are out there from the World Nuclear Association, everybody else, about what the supply shortfall is for uranium going forward 5, 10, 20 years, none of that takes into account what the added demand that is likely to come from these small modular reactors, which you're going to see lots of in coming years, that are going to do everything from running a steel mill to a large-scale mine to all manner of things. So again, there's not, even after this move from $18 to $90 a pound, there's still not a single better and relatively less risky setup for any commodity out there as there still is with uranium.
Okay, thank you for breaking that down. And the other point that I wanted to look at when it comes to uranium is, okay, so I think many investors, they've gotten on board, they've established their positions, but it's kind of an interesting setup where we've had this big move and there's still quite a bit more to go. So where are you seeing the biggest opportunities right now? Because there's a lot of different directions that people could go. And of course, it depends on the person, but what are you seeing?
Well, you want the most unleveraged sellers of uranium, I think. For example, a while back, I recommended selling Cameco. It had already had a big run. We got in a few years ago at the bottom. We made 5 times our money, whatever it was, because I think that there's more leverage with the likes of an Energy Fuels and the UEC. I think you've still got to be careful of some of the exploration plays, the greenfield plays in uranium. There'll be more of them emerging and re-emerging as the sector gets hotter, just like we saw when everybody all of a sudden decided they had lithium. in the recent past because it was a hot story. But a lot of them are still going to be a decade or more away from actually selling anything. There's a couple exceptions to that of companies that I have on my list that have got unique and already pretty much guaranteed customers, so they'll be moved to the head of the line. But right now with uranium, you want to focus on those that can sell it now and are going to be exponentially increasing their production, like a UEC, like an Energy Fuels. There are a couple of ancillary plays in some of the nuclear technology I think are interesting. But also keep in mind that as more generalist investors wake up to this, because most of them still haven't, what is the fallback position for them or their financial advisors? They don't want to shop for companies. They're going to buy URNM, they'll buy URA, they'll buy the Sprott Physical Uranium Trust, okay? And those may not be the very best bang for your buck as if you pick the best individual company, but that's where the masses will go. And just to add an exclamation point to that, Charlotte, it still astonishes me, in a way, I guess, that you've had this almost five-fold now jump in the uranium price to where now, once or twice a week, there's a segment, for example, on CNBC about it. And yet, out of 100 people who just bought NVIDIA stock, how many of them you think are buying anything to do with uranium? Maybe one. So this is something that the broad investing masses and their advisors still are totally oblivious to. And that's another reason why I think that $18 to $90 is one thing, but we got a lot more to go. Because when everybody does get into this, and maybe I think I shared this little quip with you before, in the past when I've talked about from time to time generalist investors getting into gold and gold stocks, I've said it's like a 300-pound man jumping into a kitty-sized wading pool. When generalist investors finally wake up to what's going on with uranium, and they start to get, it's going to be an elephant jumping into a kitty-sized wading pool. So I truly believe you are going to see, and there's been some nice gains from investors that got in early in the last couple of years of uranium. That's nothing compared to what's coming.
Yeah, I think the visual there really helps to kind of show how that could play out. So, talking about uranium, this is all coming to a head for uranium. A lot of it is connected to supply. And going back to your supply, there's other commodities out there that are going to face supply shortfalls. And I guess maybe I would like to take a look at, your thoughts on what could be the next story that's similar to what we're seeing develop now in uranium.
The next story, Charlotte, I think should be copper. There's been some information out there recently. I know Robert Friedland gave a speech recently and said that if you want to see any hope at all of the copper supply deficit being reduced in the coming years, you're going to have to effectively double the price from where it is right now. So roughly 8,000 or whatever, 8,000 and change right now to 15,000 or more a ton. One analyst I heard recently said that for two reasons. One is the supposed energy transition and all the additional copper that's going to be needed for that, for electrification, for electric vehicles, et cetera, et cetera. And don't forget this element of it with copper, as a lot of the developing world still is being brought into the 21st century, and they're building at least something close to modern civilizations, modern utilities, modern infrastructure, and stuff like that. You need, but between now and I believe it was 2035, you need the equivalent of 10 Escondida mines, that's BHP's big copper mine in Chile, to come online. As of now, there's not one that you can say unequivocally when you get done with permitting and finance and everything else is going to come online. So the big burgeoning shortfall of supply is as acute going forward with copper as it is with just about anything else you can name aside from uranium. The downside risk, unlike with uranium, however, near term, and I'm saying only near term, is that if we do see that the central banks led by the Fed have miscalculated and they've already tightened so much that the lag effects are going to throw us into a serious global recession, or something else causes that, financial market blow up or whatever, then just as a knee-jerk reaction, people will be sellers of copper because they'll say, well, we're going to recession, so Dr. Copper is going to get sick for a while. Won't have anything to do with supply. Now, that won't last forever, but I think that is a near-term risk. But I would say probably, my number two choice of any material outside of the gold space would be copper, and probably silver would be number three.
Okay, really interesting. And just because you mentioned silver, anything you would share on silver heading into 2024? Because I know people are really hoping to see a breakout above 25 or even 30 if we can get there.
Well, there's a reason why gold has been tagging and then retagging and then retagging and maybe making a new nominal all-time high for a while now. You're going back to 2020, really. While silver is not quite half of its all-time high. First of all, it shows you that the action in gold has been even more relegated to central bank buying and some of the more extreme risk-averse money that just wants to buy physical gold. Those people don't buy silver for those reasons. They buy gold, especially the central banks. The industrial case for silver, I think, is completely misunderstood. We're going to be going into the fourth successive year in 2024 of a silver supply deficit. Okay. So, but my long-term prognosis for silver is great. The increased demand for solar panels, a lot of technological reasons and so forth. And again, when you've had such underdevelopment of other base metals, and keep in mind that it's something like 70% of all of the new silver production comes as a byproduct. If it's going to take a long time for new lead and zinc and copper, gold, and other mines to come online, then it's going to take that much longer for more silver to come to market, all else being equal, and close that supply shortfall. So I think that silver is, I don't want to get into it, I don't want to say unnaturally low and feed some of the conspiracy theorists who every time they make a bad call, it's also the short seller's fault, okay, or JP Morgan's fault or whatever. I hear all those arguments all the time. I think that ultimately the fundamentals will win back out. And I do think that the near-term opportunity with silver is less about the energy transition and so forth than it is when gold really starts to take off, because inevitably in every cycle where you see gold make a new secular move, it takes the lead early and then silver catches up and overtakes it. And there's no reason to believe that that won't be the same this time around, aside from any of the industrial and green energy applications for silver.
Okay, very helpful for me. Sometimes I do sit there wondering what's going on with silver when we have gold so high, and that helps make a little bit of sense out of it. All right, so we've gone through gold, uranium, a little bit of silver. This is really helpful. Before I let you go, are there any final thoughts you'd share with investors heading into 2024?
I think another thing to watch, we haven't really talked about it a great deal, is the price of old energy, crude oil and natural gas, and even coal to some extent. At the recent COP28 meeting in the Middle East, it was widely covered that if you look at this from an environmentalist or ultra-greeny type of perspective, the COP28 gathering took yet another step backward. Whatever they said or didn't say at that thing, the facts on the ground, and I've got several special reports coming out about this in the coming days. If anybody wants them, just go to my website, make sure you're on my free mailing list. We're going to see a rolling energy crisis with different manifestations going forward for years to come. And one of the reasons, Charlotte, is because all of these starry-eyed dreamers that, yes, I agree with some of the philosophies and the science behind mankind has put too big a footprint on this planet. We need to be more efficient. We need to be cleaner. We need to do things better. I've never quibbled with that. But you don't get there just with words. And with, passing laws saying, well, here we've got, what did the prime minister just, do? You got to have X number by, was it 2035? Got to be all electric vehicles. might as well pass an edict outlawing the common coal. It's going to have as much impact in the real world. That's not how things get done. So because there has been no sound planning to figure out where to get all of these things and to build the food chains to provide all of these electric vehicles and make them cost effective and have the infrastructures, the places to repair them and all that kind of stuff, we're going to use oil and gas for a long time going forward. Yet there are supply constraints that are going to reemerge there as well. Here in the U.S., we've tagged recently the all-time high for production for oil. But there's several reasons I'm writing about in the near term why that's going to go back into reverse in the coming year. Policy reasons and economic ones alike. Natural gas, I think, is artificially or abnormally low right now. Yes, the weather being mild and so much of the North America has played a part in that. But you're now going to start to add substantially more to the demand equation because of ever more LNG exports. That business is booming. It's going to benefit the U.S. It's going to benefit Canada even more. You know, in the next, I think, 18 months, you'll be selling LNG out of Kitimat through the LNG Canada project. So I think that both of those are a no-brainer because the work has not been done to replace those nearly as fast as some people say, and yet there are supply constraints present and proposed. Here in the U.S., for example, new methane rules that are going to curtail or at the least add to the costs of ongoing oil and gas production. So I would not rule out that they're a lot more volatile and there's a lot more moving parts than with the other things we talked about. But from their present levels, I would want to be a buyer of old energy right now also. And I think also, Charlotte, to wrap up, that is one of the many reasons why I think that there's a rude awakening coming for people that think inflation is going to continue to go down, because a rebound to $80 or $90 for crude oil, a rebound to $4 in MCF for natural gas, both of which I think are almost done deals in this next year. They're going to bump headline inflation back up and inject some renewed reality into, again, what I've called the great stagflation.
I completely agree. I think there's a lot of words and not a lot of clear plans when it comes to these clean energy goals. And I think you wrapped it all the way back up to where we started with the inflation connection. So thank you so much for sitting down to go through all of these things with us. I hope to catch up with you again in 2024 and to see where we're at when we get into the new year.
Sounds great. Always a pleasure, Charlotte. You take care.
You as well. And once again, I'm Charlotte McLeod with investingnews.com, and this is Chris Temple with the National Investor. Thank you for watching. If you like this video, make sure you subscribe to our channel. We'd also love to hear your thoughts, so leave us a comment below. We'll see you next time.